Remember to smile. Hello, everybody. This is Taylor Johnson. I'm a realtor with Keller Williams Capital Properties, and I'm here today with Joe Dawson, lender at Mission Mortgage. He's going to talk to us about the SmartVest program, which is a really awesome option for investors looking for properties. Good morning, Joe. Tell us a bit about you and Mission Mortgage, please.
Yeah, good morning, Taylor. Again, my name is Joe Dawson with Mission Mortgage, and I've been in the DC area originating loans for the past 12 years or so. And today we're going to talk to you about a portfolio loan product, and it's called the SmartVest, as in Vest Investment. So this is great for people that otherwise would not be able to qualify to purchase an investment property. This could be business owners, new realtors, maybe just people potentially that have 10 or 12 other finance properties, and we don't necessarily want to dig into their income and debts for each one of those properties. So this is a great tool to get a property quickly. Taylor, do you have any questions right off the bat before I jump into it?
Yeah, so one thing that I really like about Mission Mortgage is the name Mission implies it has a mission.
Yep.
So what is the mission of Mission Mortgage?
So the mission, I would say, and this is my own words, it probably isn't the corporate nomenclature.
It's not what they have on the website, right?
Yeah, probably not. Our mission is to realize the dream of home ownership for people. And that's our mission and goal, to help people that otherwise would not be able to get loans to get into a new property or an investment property in this circumstance. We pride ourselves on our customer service. We're here locally in DC. We've got our in-house underwriters, processors, closers, and we know that we need to have everything in a great capacity in order to service an agent like yourself, Taylor, as well as the clients, because we understand that Taylor's referral means a lot, and it means his reputation. So we don't take that very lightly, and therefore we strive for excellence.
Okay, thanks. Yeah, and I would echo that. You do provide excellence. Every deal that I've done with you has been really wonderful and smoothly run, and my clients are not stressed or wigged out as they have been with some other lenders. The lender can really make a huge difference. Yeah. So that's a plug for you and Mission Mortgage. Thank you.
Thank you. Thank you. Always love a good plug.
So tell us a bit about this SmartVest. My understanding on a simple basis is if the income of the property covers the mortgage, you're good to go.
Yeah. So what it relies upon is something called debt coverage ratio, or DCR. There's different acronyms for it. You can see my screen here, but basically what we look at is, does the expected rental income cover the mortgage payment? And that's all we look at. So let's just say the expected rental income is $2,000. The mortgage payment, loan principal, loan interest, property taxes, homeowners insurance, and any kind of condo or HOA fees included in that can't exceed $2,000. But because of that, we don't need to dig into tax returns, pay stubs, W-2s, any of that. None of those other debts for the buyer, none of the other income for the buyer is taken into account or documented. So again, going back to the example of maybe a business owner, on the tax returns for a business owner and a realtor like yourself, what you probably want to do from a tax perspective is write off as much income as you can on those tax returns. You want to pay the IRS as little as possible. The downside to that from a mortgage lender's perspective is what you report to the IRS is
your income isn't high enough to get a loan, right? Yeah.
Right. So if you made $100,000 in gross earnings in 2021, but you wrote off 80,000 of it for marketing, travel, entertainment, home office, whatever it is, that leaves $20,000. And that's what you reported to the IRS as your taxable income. that means that we would have to use that as your taxable income. But
Yeah.
because this loan product is a portfolio loan product, we're not selling it to Fannie Mae and Freddie Mac. So we don't need to dig into that criteria. Now, I will be transparent, and this being a portfolio loan product, the interest rate is higher on something like this because
Okay.
it comes with a greater amount of risk. But when you consider what the interest rate is for a conventional investment property purchase, you might be looking at 2% higher in this situation versus not. And again, if you can't buy an investment property any other way, this provides you with that solution.
Right. So in terms of the debt, you called it debt coverage?
Debt
right?
coverage ratio.
Debt coverage ratio. So in the example you gave, it was 2000. I would imagine that it would be that there should be some factor, like
Yes.
1,500 as your total expenses and 2,000 with your rent or something like that, so that there's a buffer.
Yeah. So it depends on the specific buyer. So I've got this lined up here. The DCR is the ratio of operating income available to the debt servicing for PITIA, which is principal, interest, taxes, insurance, and association fees.
Okay.
So the DCR is calculated by taking 100% of the gross rents. And keep in mind, this doesn't mean that someone already has to be renting the property. When we get an appraisal done, the appraiser would confirm, based off of surrounding area rents for a unit like that, what expected rental income we can use.
What
now,
the anticipated rent would be. Oh, all right, cool. Yep.
Now, if there's already a tenant in the property, we can use that lease to document that. So basically, it's the gross monthly rent divided by the monthly payment. And basically, that has to equal 1% or more. So if you're a first-time investor, for example, we need 1.25 to come out of that equation. So we need that monthly rent to actually exceed what your mortgage payment would be. In a lot of cases,
for example, to make it simple, if the PITIA is $1,000 and the rent has to be at least $1,250.
Correct. And that's for the first-time investor. So we would be able to document if someone had a rental property already. We could show the underwriter the tax returns. We could show them that they already have an investment property. And then we would just need $1,000 in expected rental income in that situation.
Interesting. Okay. But in terms of making the investment, that's not smart. Like,
right.
I would not advise my clients to buy a place where the anticipated return is only going to cover the expenses. The point of having the rental is to have extra cash flow. The cash flow is really what it's all about.
Right. And this might be in some situations where investors buy properties that might be a little bit outdated, but they're livable and everything. And then they're going to go into it, put $50,000 into renovating it. And then therefore they can command $1,000 higher in monthly rent. So that I would agree with you. If someone's going to get $200 a month in income from renting their property, that's probably not the best investment, just because, if an appliance needs to be replaced, basically all of your income that year has been taken up by that. So now from the monthly mortgage payment perspective, you might think, all right, well, how much do I have to put down to achieve that monthly payment? So I'll preface, with any investment property, whether it's conventional or this loan product, usually you need at least 20% down in today's market.
20 to 25, right? Depending.
20 to 25. Yeah. The minimum being 20, but the better interest rates are going to come along at 25% down. So what we have here is basically this loan program doesn't require much different than that at all. So as long as the loan amount is $1 million or less, you need a 680 credit score or higher. The minimum down payment is 20%. But if you see a property and let's just say the expected rental income is going to be, $1,250, then we need to make sure that the mortgage payment is $1,000 or less. So that might require a little bit larger of a down payment than 20%.
Right.
But if the numbers work out perfectly, the minimum down payment needed would be 20% in that scenario.
Got it. Right. Yeah.
And
So
then-
you're going to jiggle down payment and monthly payment to make it all work out. Right.
Yep. Absolutely. And before we continue any further, I will say, before we go down this path of using this loan product, I always want to explore just the conventional investment property option with the buyers, just because that is going to result in a better interest rate for them. But sometimes that's just not feasible in terms of how someone prepares their finances. So again, this provides an option for someone that wouldn't otherwise be able to qualify for an investment property. But I always do like to explore that first option.
Let's think about that for a moment. A lot of times we talk with folks about getting a loan to get into the property and then in a couple of years refinance at a better rate or whatever. So let's say we use SmartVest to buy into a property, and it is a slightly higher interest rate. In 2-3 years, interest rates have gone down. We want to refinance. If we refinance at a conventional rate at that point, then again, we have to bring in all the tax returns and everything, right?
Correct. Exactly.
But we also have 3 years of income on this property as part of that tax return.
Exactly. So, and even if interest rates don't go down, it would, let's just say they stayed exactly where they are now, 3 years from now, it would still make sense to refinance out of this product into a conventional loan product because the interest rate would probably still be, 2% less.
Okay.
Yeah.
Okay.
But I like where your head's at.
Excellent.
Yeah.
Thanks. And what else would you like us to know about this? You think it's important to know?
So very often with any type of investor, usually it's not a one and done kind of thing. They want to build up their portfolio. And with that, very often comes the person that's doing this wants to kind of keep things organized and a little bit tidy. So they set up an LLC. We can actually close in the name of the LLC in this loan product. Now, there's a couple caveats to that. All owners of the LLC must be listed on the loan application. All of them have to sign the closing disclosures, all of that. But in this scenario, you can vest and hold title in the name of your LLC right off the bat. Traditionally, a lot of investors will close the loan in their own name, and then a month later, will go back to the title company and put the property in their LLC's title, essentially. That's not something that, it's a fine line in terms of the lenders, because anytime you change the title, you are legally supposed to, reach out to the lender and make sure that it's okay. I've never heard of a situation where, that backfired. But in this situation, you don't need to worry about it.
Right.
Yeah, exactly. Some other key points. I mean, it's pretty straightforward and simple in that scenario. One thing that you should know as a realtor is, I would lean on you a little bit on the upfront side to understand, hey, when we send the appraiser out there, what kind of monthly income are they going to get for expected rental income? That way I can run the numbers with the borrower and say, based off of Taylor's expertise, he thinks the expected rental income in this area is between these two numbers, maybe a couple $100
and then
different.
the appraiser would confirm that number.
Right, exactly. But at least from that perspective, I can get the borrower somewhat reasonable numbers in terms of, all right, well, you need to have this amount of funds to put towards the down payment in this scenario.
Right.
just to get to that monthly payment that we're looking for.
Okay, excellent.
Yeah.
So do you have like a description of the ideal person for this?
I don't have a description for the ideal person, just because this could be an ideal scenario for so many different people. I would say, the ideal person is probably an investor that owns multiple properties already, and based off of their tax returns, maybe, or maybe they just don't want to, provide the documentation needed of getting a mortgage bill, condo bill, property tax, homeowners insurance, all of that for every single property that they own as an investment.
Well, that would be a headache.
Yes. So, there, you and I both know that there's investors out there that own dozens of properties.
Yes.
And they don't want to go through that headache. And so in this scenario, that higher interest rate saves them a lot of time and effort, in which they could be, looking forward to other investment properties for. So that's one ideal scenario. The other ideal scenario is a realtor like yourself. So going back to, writing off income on your tax returns.
The expenses against your incomes. Yep.
Right. So keep in mind that
or any small business owner that's doing
right.
that. Right.
Yeah. So keep in mind that any self-employed borrower usually has to provide the most recent 2 years tax returns for the underwriter to stabilize and determine a qualifying income. So, we're coming off this pandemic. In the real estate industry, it's been actually advantageous for a lot of people. But if you're a small business owner, let's say you're a restaurant owner, 2020 was probably not very good for you.
Yeah.
So the underwriter has to average 2020's numbers with 2021 at this point. And a lot of people are unaware when they start to, think about buying a property, that this is how the income is calculated. We have to use the net income that they report to the IRS. Even if they earned $500,000 in gross income and then wrote off 75% of it, that just leaves us with 25% that we can use for them. And
I ran up against that one year. I was buying my third property.
Okay.
And my second property, I had positive cash flow, but on my taxes, I was showing a loss. And they wouldn't give me any money. And I'm like, wait a minute, I'm making money on this house. Well, not on your taxes. Like, oh,
yep.
I didn't realize that. It's like, okay,
yeah.
My accountant was doing great things for me, but it wasn't such a great thing in terms of building the portfolio.
Exactly. Yeah. And, accountants, that's their job. They're supposed to, essentially try to find ways to save you money on your tax returns, which is great. And a lot of people are very good at that. The problem with this, concept is that when you're trying to buy a home, you would need to plan, 2 or 3 years out, essentially, to do that. So, it seems like I have a conversation once a week, at least, where I talk to a self-employed borrower, wants to buy a home, and they tell me what their income is. And I always ask for their tax returns, because more likely than not, the income that they tell me is different than what we can actually use, which they wouldn't know any better. They're not in this on a daily basis. But sometimes I have to be the bearer of bad news and tell them that, the hundreds of thousands of dollars that they actually earned on paper is significantly
don't
less.
Show up.
Yeah. Yeah.
Right. Huh. Okay. So what is the geographical area available for this?
So we can do
something that is that you do, that you're licensed, that Mission Mortgage does anywhere like that?
Yeah, so I can do these in any state that I'm licensed in, which is DC, Maryland, Virginia, Delaware, and Florida. We've got a couple other members on the Mission Mortgage team that are licensed in Pennsylvania, South Carolina, Georgia, I believe. So a good amount of the Mid-Atlantic and East Coast is covered by this.
Excellent.
Yeah.
Okay. And then I guess maybe the final, you had mentioned maybe putting some money in. This is not one that can be used to finance that renovation, right?
Correct. Yeah. So it needs to be in a livable condition. This would not be considered a renovation loan or a construction loan. It needs to be, move-in ready. It can be outdated. That's totally fine. But if someone said, I want to buy a condo and it's listed at $100,000 and I want to put 50,000 more into it, can we finance that? We wouldn't be able to do that through this program.
Right. Okay. So they'd have to find that money somewhere else.
Correct. Correct.
Okay. Awesome. Well, Joe, do you think, is there anything else that we should know?
I think that pretty much covers it, but I put up my contact information here on the screen.
Right.
Feel free to reach out with any questions whatsoever. I'm here to help.
Okay, super. Thanks so much for your time today. Really appreciate it. Again, I'm Taylor Johnson with Keller Williams Capital Properties. I'm part of the Eng Garcia team at Capital Properties. And I specialize in DC, Maryland, and also up in Baltimore. So if you're looking for an investment, reach out. We can both be of help to you. Have a great day, everybody.
Have a good one.
Let's see, where do I stop the recording? There we go. Okay.
All right.
I think I stopped the recording. Yes. No, I didn't.